I think your argument for diversification, they've been trying to sell diversification since the corn farmer, they tried to pitch him to grow potatoes, right? And then he grew potatoes and they said, well, you need
No,
to get out
I,
of
I
farming.
agree with you. See, I'm not saying that diversification is the way to go. I'm saying it's like people don't know what they're buying. It's like you're buying insurance on your house, but it's
That's
actually
right.
it's only insuring one bedroom. Nvidia is making hot news. It's the first $5 trillion market cap company. So this video from CNBC was talking about how S&P 500 it became an AI fund. Let's check it out.
If you're invested in a fund that follows the S&P 500, about 40% of your money is effectively tied to the performance of just 10 companies, most of which are deeply invested in AI development.
The S&P 500 is an index that is made up of publicly traded stocks of the 500 largest companies in the United States. And each one is given a weighting based off the market size of that company.
So I was really bored of this video, but then I was thinking, right? What time do we live in where I can take $100, like $100, and I just put it down, and I come back in like 2 years, and it's maybe $200. Like, what do we live in? It's such a weird, magical time. Like, the farmers, the olden days, right? They put $100. They have to like buy seeds. They got to wait for this corn. They got to take it to the market. Like how you moved money or increased money, you have to like do something naturally or organically. And we're living in a time right now where anybody, you could just put your money in an ETF or S&P 500 and you can just make money out of nothing. And it's a fascinating time. So I want to say that that's my first like when I sat back and thought about it, we're arguing about the quality of the content of the S&P, but look at what we're doing now with things called the S&P Standards and Poor 500, stock markets, and how much wealth is being created out of really the air. It's fascinating stuff. So that's my first thought on that whole thing. What about the farmer? Holy
I mean,
moly.
that's part of the concern is that bubbles are also created with air, right? So the concern is it's a giant bubble and the earnings
Yes.
might not be there, right?
Yes.
I think this top five, it's fair. It's technology. And last years, last decades, we increase level of consumption, technology, technology, technology. Even 20 years ago, mm, we don't have like cell phone in each hands. Children didn't have cell phones, but now they have smartphones since kindergarten. And if you're talking about Nvidia, they started like technology company with graphic design, processing units, and then they think, okay, what we can do more and innovate, innovate, innovate. The same Microsoft, Apple, Meta, they don't stop. They think, what is next? And using the last technologies. AI is coming, all right, how we can implement and innovate more. And more people, consumers want to do it. Farmers, okay, we can eat, but we can eat less. But technology, we use more. So this is, I think it's reasonable why this top five is high technology
I,
companies.
I guess you see Nvidia signing contracts with like the government and all these big companies and that's why their earnings, are going up. So then investors get excited. So then everyone starts buying the company because they get FOMO, fear of missing out, and everyone wants to ride the wave up. And I guess the issue is the video goes on to say that Nvidia alone is 7% of the S&P 500. S&P 500 was created kind of as a diversification away from the Dow Jones Industrial Average, which was the top 30 companies.
Mm.
And people wanted more diversification. Just to be clear, that's why you buy one of these funds so that you can own a little slice of every company. But if you have one company taking up 7% and 10 companies taking up 30% of that pie, I guess the issue that they raise in the CNBC clip, and we'll watch in a second, is that investors might not know what they're buying. They think they're buying diversification, but they're actually buying, they call it a mega cap tech fund. So like
Ah,
a fund, a portfolio that's actually heavily skewed toward tech, and they might not know that.
But another argument is they are buying diversification when they're buying the Nvidia because Nvidia itself is becoming a diversified company. If you look at the other company on there, Google's on there. Google's really interesting. Google is now they started off, look how they started off, a little chat, right? You would Google something, but they've moved into things like quantum computing. They got data storage. And when you're buying these companies, these are really smart companies. They're run really well. And within, that company, they have a portfolio manager themselves who are going out there and they're buying different diversified businesses that do align with, it's almost like they're buying the entire supply chain. They're buying the supply chain, they're buying the future. I find them very fascinating. Same thing with Microsoft. Microsoft starts off making, operating systems for, IBM PCs. Now they have massive data. They also have quantum computing. I think the biggest issue here is what they talk about. If you're in it for the long term, you're going to be okay because you're going to go through the oscillations. But the majority right now, what's happening demographically in the United States is that people 55 own 80% of the stock market. People 65 own 43%. And the key one is people who are now turning 73 who have to start cashing out. They own about 20 to 30% of the stock market. So if they're all like a massive amount of people are retiring at the same time and they're forced right now to pull their money out and their money's invested, and then Donald Trump or somebody gets on and does something where the markets tank that couple of months, like you had in April, people who are retiring at the mass amount of them are going to be in a big problem because the market moves so quickly today. I think that's where they're trying to tell you, you got to almost diversify, not your portfolio, but you got to diversify for the time of your life. You can't be a 73-year-old and then all of a sudden the market hits April, like 2025, and it tanks 20, 30%. And that money you had 100,000, now you're down to 700,000 or a million down to 700,000. You're in problems right now. So I think that's what they're trying to warn people about. Yeah, let me get some popcorn.
Clip, and like I said, that's why Google became Alphabet. It's not only Google right now. I just see it's like 10 plus different direction.
Yeah.
Human health, even autonomous driving, drone-based delivery. So it's like, wow. It's
Wow.
not only search system services.
Yeah, and that's a great thing to look at because they have the most money. And
moonshot technologies. So
yeah,
wow.
yeah.
It's something extra. It's not like front-end browser images. No.
I mean, I kind of want to push back a little because you could have said everything that Isvar was saying in the beginning, what he said, you could have said of the 2000.com bubble. Said, well, if you just invest in these companies and you ride it long enough, you'll make money. But it wasn't true. A lot of them went out of business. And like, say that you bought Intel at the peak of 2000 bubble, like you didn't. If you look at the curve, you didn't see a break even until like 20, 25 years later, and you saw losses all those 20 years. And I guess the concern is if there is not a bubble, then there's no problem. Everybody, because see, everyone's going toward this passive investing these days, robo investing, set it and forget it, non-active, portfolio management. That's record amounts of capital are flowing into these kind of products. And if people are just throwing money in and they don't realize they're throwing it into tech and the tech is in a bubble, like if it's true, if we see growth like what we saw from Meta from 2010 to 2020, sure, yeah, no problem. Everything grows, everything's fine. If this AI revolution bubble turns out to be more of a dot-com bubble burst, that is where there's some concern, where there's millions of people passively investing in tech, not knowing it, and tech doesn't generate the returns promised.
Look, I think the funny part of these, when we talk about bubbles are part of the culling, the burning of the fields. It always happens. There's a great story about Sir Isaac Newton. The guy's super bright. The guy with the apple, the apple guy, gravity.
And a virgin.
Yeah, whatever. And a virgin, right. He invested in the East Indian whatever company, I don't know, made millions or whatever back then. And, everybody said the guy's a genius. The apple, right? And then what did
I
he
didn't
do?
know that he invested in
Yeah,
the
he
East
did.
India Company.
And then I think he got his money out, and then he got excited and he reinvested again, and he died dirt poor. He died dirt poor.
Scientist.
I mean,
Scientist.
yeah, whatever. My point is, it'll take it. The bubble is coming. It's going to take whoever didn't get out fast enough, who got in and didn't get out fast enough, it's going to take you out. So it's unavoidable, is my point, right? And I think one of the things I've kind of learned is It's going to come a bubble, and there's nothing wrong with a bubble. You can jump on that bubble, make your money, but you got to know when to like, you know, cash in and get the hell out. Now that's always the challenge, right? When do you cash out? Like, and then greed and fear take the marketplace, and it's kind of a behavioral psychology of economics. It's like when things are going up, you don't want to sell, right? And when things are going down to the dirt, you want to keep it just in case it goes up. You don't know when, you don't want to get out of it. And I think that's going to happen no matter what. That's just kind of how the world of investing works. So
That's the idea of diversification, though, that if one of the stocks falls in the portfolio, then others will rise, and so you're kind of insulated from that, all of them crashing at the same time,
Mhm.
which happens from time to time, economic downturn. But like if, Nvidia tanks tomorrow, you still own all the other sectors, and the sectors tend to move like, they tend to move in the same direction. All of tech, all of consumer goods, all of utilities, they tend to move up and down together.
I think your argument for diversification, they've been trying to sell diversification since the corn farmer, they tried to pitch him to grow potatoes, right? And then he grew potatoes and they said, well, you need
No,
to get out
I,
of
I
farming.
agree with you. See, I'm not saying that diversification is the way to go. I'm saying it's like people don't know what they're buying. It's like you're buying insurance on your house, but it's
That's
actually
right.
only insuring one bedroom. Like,
Well, I mean, isn't the argument rather than is just get better educated? I mean, if you know these things are
yeah,
happening, I mean,
I mean, I'm a
diversification is one
trader,
thing.
and watching this video, I didn't even know there was that they mentioned at the end you can buy a S&P 500 that's not weighted by market cap. So you get an equal weighting of Nvidia, whatever, 1 divided by 500 and is the same weighting as XYZ company that is very small. The way that most people buy it, it's, it changes actually. So as the market cap or the total market value of the company goes up, so as the share price goes up, uh, more of the S&P is weighted toward the bigger companies. But, like, I mean, if even someone that does this every day, like me, didn't know that that product is out there, I think you're right. We need more education about this kind of thing.
So let's be
So,
educated. Turn on the video, the next part.
For many people, and I would say most investors in target date funds, a significant portion of your portfolio, particularly equity, is in the S&P 500.
I think investors have gotten so used to the idea that the S&P 500 is a relatively low-risk way to invest, and it's kind of obscured the fact that it's a technology mega-cap fund today.
Others feel this bias toward tech and AI is an opportunity for investors to get ahead.
I think tech continues to lead the market higher, and that ultimately has really changed the game for investors.
That guy there, Dan Ives, interesting that he's there because he just launched his own ETF. I believe it's a quantum or Bitcoin ETF, his own, right? His own branded ETF in the name of diversification. So you can see everybody each time they keep introducing a new product. This product gets to be problematic. And then even he last week, I think he raised $1 billion for his ETF. What I'm saying is each time there is like this challenge with the existing uh, instrument, right? We're in a place where not only we're not telling people don't buy individual stocks, you can buy a basket of stocks like a mutual fund. And then we're telling them, well, why buy just a mutual fund? Why don't you just buy the entire market, right? Which is the S&P and the Dow, like buy a portion of that entire market. And then other people are saying, well, why do you buy the whole market? Why don't you buy an ETF which invests in the market and then you'll get some sort of potential dividend payout? So each time they keep levering it up to another product to take advantage of the base product. And then if you really look at it, the biggest problem is if the whole thing tanks, like a house of cards, because they're all built on profit models on one another, right?
and you
That's the
can't
problem.
diversify that away to your
No,
point. If the
no,
system crashes like 2000, 2008, 1929, 2020, COVID, everything goes down. You cannot, diversify that risk away.
not at all.
Except gold. I think when it's seriously, when it's crisis, so it started like a huge increase when we got this COVID hysteria and everything, when the wars here and there, and just
Yeah, gold
skyrocketing.
they considered it a negative beta, right? And then the
Mhm.
beta is they're measuring the movement with the market. But gold is a negative beta, meaning it will not only hold itself when the market is moving, gold is like under zero. So it's going to go the other way. So
Yeah.
that's your commodity balance, right? And they're trying to do that with Bitcoin, right? But I still don't understand I still don't understand Bitcoin. That's a whole
I
other.
just keep a small amount of Bitcoin and just open it sometimes. Oh, increased.
Oh, you got
drop
Bitcoin.
off.
Look at that.
A small
Yeah.
one.
Yeah.
And
I mean,
5
it's
years
crazy.
ago, I got some rates, like maybe more than 150%. I just take it back. And then,
Yeah.
but during these years, I bought in 2017, wait 4 years. But during these 4 years, I cannot sleep. I couldn't sleep because it's always Bitcoin. Then Bitcoin. Oh, okay, should I take it? Wait, should I? No. Wait. So, and finally, when I see it's like, wow, all right, I will take what I invested, then little bit more, and keep a small amount. And now it's not that. In case, just keep it. Don't forget the password. The password.
What a
Wallet.
weird commodity.
It's funny you mentioned beta because, like, you're right. Gold is traditionally like less correlated with the stock market's return. So, like after 9/11, gold, went through the roof because when people are afraid, they tend to put their, run to gold. And it's like, and yet it's kind of, anti-gravity the last year or so. Gold is on this record run. At the same time, the market is on this crazy run.
Yeah. Weird. Yeah, it is weird. Yeah, I own gold. I actually have gold coins. They're right behind me somewhere. My wife has hidden the gold coins.
I don't do
I don't
the
know.
gold. My wife, she has gold bar or whatever. It's like
Yeah.
I don't mess with it. Like if I'm gonna do gold, I buy the gold miner stock because at least it pays a dividend. But
Right.
a lot of top investors like Ray Dalio is big on gold. He says to own at least like 7 to 15% gold in your portfolio. So like everybody has different investment strategies and philosophies. I guess it's not like to say who's right or who's wrong because nobody really knows and we can always find data to back up our claims. Are you actually buying what you think you're buying? It's
Yes.
like when you buy the hot dog, you're not buying meat. It's hot dog. But when you buy the S&P, you think it's prime rib, but it's really hot dog. Like that's what,
Yeah,
that's
but
what they're
that's how
saying.
but they sold the S&P like that. They're like, don't worry about it. We're gonna manage it. We're gonna put the weighting in. We're gonna take care of it. Just give us your money. That's how all of these instruments are sold. They're not asking you and educating you. That's why I'm saying education is
Well,
probably
the
the most
S&P
important
is a
thing.
little different is that they're not actually taking your money and managing it. Like they're just tracking the index. They're just buying these companies in this ratio. So like that's not like they're picking stocks. And every I'm not sure if it's every year or every quarter, but they kick out the
Yeah,
losers and bring in the winners. So they
right.
reshuffle the companies every so often. So you're always owning the 500 biggest companies generally in America. And uh, you know, actually, if Elena talked about investment horizon, I think it's or timing or something. You know, if you're holding for a longer term, that's actually not ideal. You should actually be holding smaller companies that are riskier because your return will be higher in the long run. Like as already said, if people are older and they're worried about their retirement and cashing out at the right time, then they should be buying these big caps. I think it's just we want to make sure people are like buying what they think they're buying. And, the argument from what was the guy's name that started the
Ives
coin fund?
something Ives. Yeah, yeah.
You know,
I don't.
you see him arguing against that, saying, well, because the economy is skewed toward tech right now, that's where the value is, that's where the growth is coming. And so it should reflect that.
Yeah.
That's a valid counter argument.
It is a valid counter argument because that's where investments are going. That's where companies are going to be aggressive, trying to build the economy. That's where income is coming from. I mean, if you're a contrarian and you say, well, in this tech heavy, I'm going to go out there and invest in hot dog farming, like maybe, I don't know. I mean, who would like, are you nuts? Like, so yeah, I think it's a great argument. I think the thing is get educated and know about timing. Like really, if you're in your 50s, 60s, if you're in 70, 71, you have to cash out in 2 years. And Ray Dalio is probably 70 something years old, and he's like actually saying the thing which older people should understand, is that your horizon and you've got to cash out in North America. I think it's 73 in Canada and the United States. You're forced to cash out. You have to start your deferred retirement plans that most of the stocks in. You have to start pulling it out by law because the government wants their money.
Mm-hmm.
If not, you're penalized. So they're going to take their money no matter what. So, because the demographics in North America are skewed heavily for older people, of course, there's a big challenge right now because a lot of people are going to be forced in a certain time to get their money out of these stocks. And if the market's like this with, like you're saying, S&P 500 and Nvidia, then you're in big problems.
A lot of
So
selling all at once. Yeah.
all at once. Yeah.